All right, y'all, here's my little tip for today, and this is what I'm doing. And so what you do is you have an index universal life insurance policy, or you have a whole life policy that has something called paid up additions. This will work with either one of these policies if it's structured right. So it has to be structured so that 70% of what you put in goes toward either the paid up addition or it goes towards the Roth account that's inside the index universal life. You with me? So, for example, I have a whole life policy that has a paid up addition, and only about, I want to say, $80 a month goes towards the life insurance. It's a combination of term and whole life insurance combined. All the rest of the money goes into something called a paid up addition. So what I am able to do is I am able to borrow money from the paid up addition and be my own bank. So I can borrow money from it, and all I have to do is pay it back at 4%. So the idea here is to borrow the life insurance company's money while your money continues to grow inside the paid up addition. So the paid up addition is going to continue to get something called dividends. So when you own a whole life policy that's a participating whole life, that means you own shares of the life insurance company. So they pay you dividends inside of the policy. So when you borrow money from them, your money stays inside of the policy and continues to grow. So what I do is I'll pay off the debt. Like right now, I'm about to buy a Mercedes, and I'm just going to take a lump sum of money from the paid up addition, and I'm going to take a lump sum of money from the Roth account, and I'm just going to, instead of using my own cash, I'm going to pay off a Mercedes. I just found one that's burgundy and gray. So instead of getting a predator loan from a car loan place, and you end up paying 2 times the value of the car because the loan rate, interest rate is so high, I'm going to self-bank. I'm going to be my own bank. So instead of borrowing money from a bank, I'm going to borrow money from my life insurance policy and pay off the Mercedes. You with me? That way, I'm just borrowing $30,000 at 4% interest for the year, instead of borrowing $30,000 from a bank and they're charging you interest every single month and you never pay off the car. You with me? So that way I can pay back my life insurance policy the same amount I would have paid back the car note. Easy, right? And if I don't pay them back, at the end of the year, they'll decrease it from my death benefit, which I don't ever do. I always pay back my loans fast because I love it when I see at the end of the year that my cash value has gone on steroids, right? So at the end of the year, if you pay off your loan plus the interest, your cash value goes on steroids. So the secret is pay the interest off first. So for example, if you borrow $1,000 and the interest rate is 5% for the year, that's what, $50 in interest? So you pay the $50 off first. If you don't, that interest will eat away and multiply the loan. So that interest will just keep compounding and compounding. So I call it hit the devil first. And the devil is the interest rate. So hit him first. Pay off the interest first. And then everything you're putting into it will be paying off your principal, right? So there's a good key. Pay off your interest first. And then everything you put into it after that is paying down the principal. You with me? If you don't get that, just send me a message and I'll break it down to you. So I am going to be my own bank. I'm going to self-fund or loan for the value of my car. So my car, now cars are normally depreciating assets, right? So if you buy a car, every single year, the value of that car decreases. So you're not supposed to borrow money for a depreciating asset. That is just a rule of wealth. Unless the car is making money for you. So this particular car is going to make money for me because people will be attracted to me. It's my school colors. And people will ask questions. Well, how did you buy your car? I'm going to say, hey, I used my life insurance policy to pay off my car. I bought my Mercedes using my life insurance policy. So when people ask me about my car, that opens up the opportunity to show people how to be their own bank. So that's the plan. What do you think about that plan? Say something in the comments and tell me what you think about that plan. This principle can be applied to any loan, y'all. So if you have a loan, and no matter what kind of loan it is, rule number 1, pay the interest off the loan first. Those of you who are doubling up on payments on loan, you're getting nowhere fast. You know why? Because the interest is still compounding. As long as the interest is compounding, you're taking 3 steps forward to take 4 or 5 steps back. So again, call up the loan company, whoever it is, say, how much do I need to pay off the interest? Get that number and then pay the interest off first. Then if you double up on the principal payments, then you'll actually see the balance of the loan go down. If you don't do it that way, you're just wasting time. So that's my tip for today. Listen, if you would like to do what I'm doing, reach out to me at Rhema, RHEMA, financial coaching at gmail.com. And let me show you how to take a life insurance policy and use it to be your own bank. It is so much fun and it is so much better for us financially. All right. Love you guys. Bye.